All right, let's get a sense of what's going on locally in the market. James Gerrish joining us from Shaw and Partners and Market Matters. James, a good morning to you. And it's the last day of the month. How did you sum up November?
Yeah, good morning to you, Andrew. It is the last day of the month, mate, and it's been a pretty solid November to date. The ASX, just looking at the numbers here, so the ASX has added more than 5% month to date. So we've had some pretty strong performances in terms of what sectors have done. Utilities up nearly 22%, materials up nearly 15%. The worst of them has been energy, but it's still positive, up 0.8%. So a very strong month for November, and that was coming off the back of a reasonable recovery in October.
Of course, a lot of focus on what's going on in China at the moment. How's that informing your investment decisions at the moment? Have you got any particular stocks you're watching?
Yeah, I think the biggest read-through for Chinese, what's playing out in China is obviously the resources stocks if you're not holding direct Chinese equities. So, we saw iron ore tick up back up through $100 a tonne yesterday. We've seen coal prices continue to recover from recent weakness overnight. So they're up another 3%. And some of the coal stocks have been, recovering from their 20-30% pullbacks in prices. So, I'm bullish on the resources trade. We've got a reasonable allocation across portfolios in the resources, and I think this rhetoric coming out of China that they may be stepping back from the COVID zero policy. They're going to increase the increase some support for property developers and the like. So that's obviously going to be pro-growth measures and going to be supportive of our resource stocks. So bullish the sector, Andrew, and we're positioned for that.
That does, though, come with risk, doesn't it, James? Because the policy outlook for China remains fairly opaque at this point. We can't be certain of where they're going to take it, particularly as far as its zero COVID policy is concerned. So clearly you need to be wary of that.
Yeah, that's a really good point. You don't go out there and buy resources stocks simply because of what Chinese policy is going to do. We all know how that can ebb and flow and change with the wind. So I wouldn't be advocating buying resources stocks only on that, on those headlines, if you like. So resources comes down to the supply-demand dynamic. So obviously the improvement in China improves the demand side, but we've also got some supply side issues across a broad range of commodities. Obviously the most obvious one is in the coal space, but we've also got, you look 12 to 24 months out and things like copper going to deficit, the demand there is going to increase, yet we haven't had a meaningful increase in supply. Iron ore is probably perhaps one on the other side of the spectrum where supply is continuing to increase probably, and that's probably going to keep prices more range bound than anything. But so demand supply is the key driver. China's sort of a side story, but it does feed into the overall demand for underlying commodities, Andrew.
Well, you mentioned copper. That price, of course, has been under pressure in recent months. So if you're looking for that strength to return, specifically, where are you looking?
Yeah, so giving you an understanding of copper price, it has been range bound. So $4 a pound, down to about $3 a pound, trading now about $3.62 a pound overnight. So it has been range bound. We're in the middle of the range at the moment. Obviously since BHP is taken or is in the throes of taking Oz Minerals out, then the headline copper company on the ASX is Sandfire, and that's where most investors will turn to. So we've got a big overweight in Sandfire. We think obviously they've done a pretty opportunistic capital raising 200 million. They've got a new CEO coming. They've got some well advanced plans for the next 5 to 10 years. So to me, that looks like that looks like a really good bet in the copper space. It's also underperformed pretty significantly, Oz Minerals, over the last couple of years. There's reasons for that. Operationally, they've struggled a little bit, whereas Oz Minerals has been particularly strong operationally in the last couple of years. So to me, Sandfire is probably the place to be in copper.
All right. I see you've also taking a look at the property sector at the moment, of course, in the face of those rising interest rates and how that's impacting. Specifically, which sectors in property are you watching at the moment?
Well, I think we're focusing our attention on where the market will move to next. So you made mention of higher interest rates, but that's well and truly, in my view at least, factored into these valuations. So something like we don't own it, but Dexus, we've looked at that this morning in the Market Matters report. We've owned it in the past. We recently sold it, or not that recently, I guess 12 months ago. We sold it sort of nearer $12. It's now back sub $8. To me, that looks interesting. Office, no one wants to talk about it. We all know there's a lot of uncertainties around office, but these guys are trading a 30% discount to their NTA. Is that enough for the complexity and the uncertainties out there? I think it probably is. So you can buy something like this that's got reasonable gearing. It's on 12 times. It's going to yield you 6%, and also you've got that disconnect between NTA and share price, where a lot of this negativity is already priced in. So as I look to 2023, I think it's pretty clear that central banks are going to slow the pace of interest rate hikes, if not stop them. That's going to be positive for equities broadly, but it's also going to be more positive for the property stock. So Dexus would be a deep value one we don't own, but we're looking at in our income portfolio, we currently hold Stockland and Centuria CNI. So they're two stocks we like as well.
All right. So James, more broadly, I mean, you talk about central banks they're looking to pause next year, which will be broadly supportive of equities. Yet there is obviously the prospect of recession, well, certainly overseas, with lower economic growth here in Australia at the same time, which is going to impact earnings. So when you look at how that's going to play out at an equity level, what you're expecting then, we are going to get that Santa rally. What about early next year? Do you feel as though it's going to come off?
Yeah, if I'm having a stab in the dark, I think probably the start of 2023 calendar year is going to be a little bit muted, finding direction. It's going to come down to obviously what inflation does. So we've got an October print here in Australia at 11:30 this morning. The market looking for 7.6% at the headline number. But so those trends around inflation will be key to filter into interest rate expectations. But you've got to remember, Andrew, that the market prices the future. If my inclination would be, if we start, if we get confirmation of a recession, that's when you want to be long equities. All of that has already been priced in. I know the market's rallied 13-14% from the lows, and that's why I'd be a little bit cautious going into the very start of 2023. But ultimately, I think dips are now worth buying, and I think we can be a little bit more patient selling rallies. So my mentality is a little bit more bullish than perhaps the broader market has been. We've spoken, for the last couple of months around bearish positioning in the market, and the reason why we've been more bullish than the consensus, and I think that's played out. And I think ultimately very short term we're a little bit more cautious, but overall I think we can be buyers of dips going into 2023.